So it looks like we've got another day of Wall Street insanity ahead of us. The market has been rallying the last couple days on poor economic data, which may sound counterintuitive, and it should, because Wall Street's logic on this is that, well, if there's poor economic data, well, then the Federal Reserve is probably going to cut interest rates. But if the Federal Reserve cuts interest rates, well, stocks will go up. So everybody's buying stocks. But of course, the Fed cares much more about the stock market than they do the overall economy, because they understand that that's what drives consumer confidence. So if the market is rallying, even though we have somewhat weak economic data, although it's not a total collapse yet, the Fed is going to wait to cut. So the market's shooting themselves in the foot here. If they were looking for a cut, then everybody should be short right now and trying to encourage the Fed and play chicken with them and get them to sort of turn away. Because, frankly, even Jerome Powell, I think, would avoid cutting rates when we're approaching all-time highs yet again. I mean, we're pretty close at this point. This current rally that we're in from, last week and into the beginning of this week has been perfectly vertical almost. And so the Fed really has no excuse to cut rates at this point. Everyone who's buying right now should keep in mind that if the Fed really is going to fulfill all their desires and cut interest rates, well, then that means that at some point there's going to have to be a drawdown in stocks to some extent to give the Fed that opening. It's just not reasonable for the Fed to cut at this particular level. Now, who knows? I could be completely wrong, but as reckless and dovish as the Fed is, I think even they would be embarrassed to cut at this point. Now that surely, if I am indeed correct, it would not make the President of the United States particularly happy, considering that he's been trying to push the Fed for a couple months now into cutting rates and returning to QE4. And after Powell's act as appropriate speech from, was that only last week? It feels like so long ago at this point. It's pretty clear that the Fed is prepared to cut rates and return to QE4 if the circumstances necessitated it, which may have been behind some of the president's aggressions on the trade war front. Because if the president is putting, trade pressures and raising tariffs and hurting the U.S. economy that way, well, then that, even if stocks necessarily aren't going down, could give the Fed a bit of an opening to cut rates, because they could say that they're cutting rates to compensate for the tariffs. However, on Friday, after we got the bad jobs report, which some people, based on, I believe it was Bullard of the St. Louis Fed, based on the way he was speaking, some people thought that if there was a bad jobs report that day, that it would guarantee a rate cut. And perhaps the president was one of those people, because later that day, after the jobs report came out, President Trump announced that they had reached a deal with Mexico to avoid the tariffs, which were supposed to go into effect today. Now, I think that perhaps this may have been a little bit of a mistake on the president's part if he assumed that the Fed would automatically cut rates based on this jobs report alone. I think that the way the Fed was looking at it was that given everything else that was currently happening, the drawback in stocks, the slight drawdown, pullback in stocks, the trade war on both the Mexican and the Chinese front, if the jobs report came out and was bad on top of that, then that could be the Fed's excuse to cut rates. Because if you think about it from the Fed's perspective, the Fed is at least trying somewhat, even though they've really thrown away a lot of the pretense. I think that there's still an instinct there that they need to somehow justify their actions in the context of the dual mandate of maintaining stable prices and low unemployment. So therefore, if we have the drawback in stocks, the trade war, and then a bad jobs report, well, then the Fed could say, okay, well, the trade war and the drawback in stocks is clearly manifesting itself in the labor market, and we're seeing an uptick. This is affecting employment now. Well, then we're going to act to compensate for that so that we maintain low unemployment. However, now that the president has solved the Mexico problem that he created, well, the Fed has less of an excuse, because they could then now come out. They don't have that to appeal to say, okay, well, this explains the jobs report. Now they can only really rely on, I guess, the worries over the China tariffs. And of course, the stocks are going back up now, so they've lost all the bad news that they could have used, because in Wall Street's eyes, bad news is good news because it gives the Fed an excuse to cut. Well, now all the bad news has kind of just puffed and disappeared in the short term, which means we're going to have to wait for more bad news later on, and at some point stocks are going to have to go down, or else the Fed is not going to cut. And this is troublesome for stocks even more, because the futures markets have already priced in 3 to 4 Fed rate cuts this year. And so the prices in the equity markets and throughout the financial markets are pricing in those 3 to 4 rate cuts right now. So therefore, if the Fed doesn't cut as much as expected, well, then that's sort of an implicit hike, because prices will have to adjust then to where they would be under those tighter, relatively tighter circumstances. If the price of a particular asset has 3 rate cuts baked into the cake, well, then if it only gets 2 rate cuts, well, then the price is going to have to fall accordingly. And of course, the Fed doesn't want that, since Powell said they will do everything they can to extend the business cycle. Now, there is good news, historically speaking, for the markets, because the Fed pretty much always acts as expected in modern times. The Fed is too afraid of the markets to try and challenge them. They are, in fact, following the way that the markets are moving. Now, the bad news is that by the time that the Fed does start cutting, it's typically because the Fed is anticipating that there's going to be a recession, even though they would never say that out loud. But if there wasn't, they would have no reason to cut, really, because that's always what they're concerned about. The economy is so fragile that we can't handle a drawdown or drawback in stocks without a recession. The economy is built on the wealth effect. It is nothing but a Ponzi scheme in which the Fed prints money, gives it to the banks pump up Wall Street, and then people who own shares and in stocks and things and own financial assets, well, their net worth goes up, and then they can consume more, and that drives our economy. And so obviously, then, if stocks go down, those people will have less money to spend, and then everyone else who serves those people, who serves the chosen few who benefit from Fed policy, they will all be out of a job as well, because those folks, those rich people won't have as much wallpaper they need hung, they won't have as many additions built onto their house, they won't own as many homes, in Florida or wherever else they buy vacation homes. And so this is the purgatory where the market finds itself in. It's rallying into its own demise, because either if the market keeps rallying and the Fed doesn't cut immediately, well, then the rally will stall out. But if the Fed does cut rates, well, then that means that the rally crashed and burned. And of course, we still have no China deal. And based on the president, the way he's speaking this morning, I would say that no China deal is coming, because he basically said, "Oh yeah, the Chinese, they'll make a deal. They got to make a deal," as if we can't. The Chinese can't hold out as long with the tariffs as the U.S. can. That, I think, is a load of hogwash. The Chinese have a much lower standard of living to begin with, so if their economy suffers significantly because of these tariffs, even if they suffer more than the U.S., I think that the Chinese can handle that much more politically. In the U.S., every president rises and falls based on economic data, even though the president himself doesn't have that much control over the direction of the economy. So therefore, if these tariffs significantly impact they will significantly impact the economy if they stay on for a long period, the president will be the one to suffer far before Mr. Xi. So I think that about does it for today. Just watch this week for that rally to come and stumble. It'll probably happen at some point, although that may only be after we make new all-time highs. I mean, we could hit 3,000 on the S&P, and we'll just have to see, but I don't see it going much higher than that, because this is all speculative mania at this point. They don't really have anything that they can rally on sustainably. So if you got anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you back here tomorrow.